this event, and I will pay attention very well to it. So let us start. Of course, the second hour, as I told you before, is going to talk about techniques. Since this is the first day, I wanted to start with something light and to talk about something very important. Light does not mean not important. It means something we can talk about while we are relaxed and not talk about prices that go up and down all the time and keeps us busy like that. So this hour we'll be talking about the trading techniques, and today I wanted to talk about risk management. Risk management by itself is not a trading technique, but it's a technique or a group of techniques that should be used all the time. You cannot go into the market expecting to make money while you leave your risk just hanging out there. So if you don't manage your risk, you cannot manage your money, period. It's very easy to say. I don't think anybody can I don't think anybody can say no to that. Okay. First point that I want to talk about is where to place the stop. I will talk about long position, a buy position, and of course everything said should be reversed when we are talking about a short position. What kind of support levels can we use to place the stops? First of all, there is the very well-known horizontal support or resistance, of course. We also have our trend lines. We were looking at some very fine trend lines in the previous hour. And we have our moving averages. We also took a look at that while analyzing the market this morning, or maybe not morning if you are living in a different area than me. And finally, we can use the retracement levels. We should always hide the stop in the right place. I mean, if there's a support, let's say the euro has a support at 10.21. We don't place our stop at 10.21. That would be like giving your money to the market. You should hide the stop below this level. But then again, there's another opinion that I have come to admire through the years. And this is what we will talk about here. Where to place the stop? Below immediate support. Immediate means the support we are talking about, the one in front of us, not far at all. It's very close, it's here. Okay, we'll take a buy. Get me that long position and just let me place the stop very close to it, just below the immediate support. Another view, which I am a big defender of, is below the next support, and you'll see why. And we always have the question of how many pips below a support should we place the stop. I am always asked this. So let's talk about the first option that we have. We can place our stop below immediate support. We have support at 10.21. Let's say that the price is currently at 10.30 on the euro dollar. Okay, I'll get in. I'm buying. The support is right here, so I'll just place my stop just below this support, below 10.21. What are the pros and cons of this method? First of all, the pros are that we have very good market timing. We are buying at a support, and that's something I encourage you to do. A lot of people get in just because they want to get in. The price is not a support, not at resistance, not at any important level in the market, but I think it will go up. I have a feeling that it will go up. That's not a reason to get in the market at all. That's a reason to wait, to watch the market and wait for it to touch an important level. After touching that important level, we can look for signs of reversal the price want to reverse to the upside, if we're talking about support, of course, or continuation if the price is pushing below this support. And depending on what the market is telling us around important levels, we should take the decision. But we cannot make a professional decision in the middle of nowhere. No professional trader gets in the market in the middle of nowhere. People with good knowledge and experience of the market, they wait for important levels and they get in at these important levels. So when you get in at an important level, at a support, like the one we are talking about right now, 10.21, you are getting in with a very good market timing. Another point that this method is known for is that the risk will be very limited. Of course, if I buy at 10.30 and support is at 10.21, I have 9 pips to the support. If I want to place the stop 20 pips or 10 pips below that, that's 19 pips of a stop, 29 pips of a stop, and that's it. I'm not risking 100 or 150 pips in this trade. So I know where to get in. I know that the support is very near, and I know that my risk is extremely limited. Okay, what are the cons of this method? First of all, it can be easily hit. Why? Because what kind of news or turbulence or demand or support does the market need to move 19 pips? You know, it can happen at any time. It's not a long distance. So it can be easily triggered. And one other con, or my favorite among the cons for this method, is that this is arrogant. I'm sorry to say that, but it is. Why is this arrogant? Because you think that you are such an unbelievable analyst or trader, and you are so good that the market will not go 9 pips against you. I'm buying at 30, I know support is 21, it will not break the support, so it will continue going up. So you think that you are so good to the point that the market cannot go 9 pips against you. That's arrogance. It's simple. That is arrogance, and traders should not be arrogant. You should be always thinking of what a trader am I, what a small trader am I in this huge market. You know the size of this market, right? The number of trades and the amounts of money traded in this market every day are beyond imagination. So every individual trader, even if you have 5 million or 10 million account, does not matter. We are all only drops of water in an ocean of trading. So we cannot be arrogant. Okay? Now, I want to introduce this to you. Of course, the first one is talked about all over the internet, in the seminars, everywhere. Buy at support, place the stop just below the support, and that's how you do it. Well, my favorite method is a little bit different from this. I place my stops, or I advise my clients to place their stops at or below the next support, not at the next support. So if we have a support at 10.21, ask yourself, where is the next support after that? I'm buying at this support, but I don't want one support to help me win this trade. I may need the support of another support. So where is the next support? We take a look at the charts. I have done my homework for the euro. For today, we have at 10.21 and we have at 9.73. So I go and place the stop below 9.73, not below 10.21. Of course, here there's a very important point to make, and that is the risk management point. Forget about analysis, forget about the support level, the chart, what it says. If I place this stop below the next support, how much will I lose? If I see that the difference between one support and the other is 80 pips, and I still need 20 pips or maybe more, to consider the second broken, and I may not be buying exactly at the support, first support, maybe 10 pips above it. So 10 pips and 80 and 20, that's 110 pips. That's a huge stop. So I have to think about it again. But when it's like 40 pips between the support and the next, that is what I really advise you to do. The pros are, we still have very good market timing, of course, because we are buying very close to the support, and we have reasonable risk. This is very important. If the distance between the two support levels is huge, we cannot risk that much and place a stop at 110 pips. But if my stop after placing it below the second support is 60, 50, something like that, that is still tolerable. Okay, what are the cons of this method? We have one very obvious, which is it comes with a larger risk compared to the previous method. We cannot expect a 29 pip or 19 pip stop like we expected with the first one. This stop should be larger than this. So you can always estimate what to do. I highly advise the second one, of course, but when the distance between the two support levels is not very huge. Okay. Now the age-old question. How many pips? Should I place a stop 10 pips below the support? People ask me, should I place it 20? Should I place it 30? How much? There are a few factors to consider when deciding how many pips we should hide behind the support. The first is the average daily range, the volatility. Not all instruments move with the same percentage or the same number of pips every day. You know, we have these instruments that if they move 50 pips from high to low, that is a big day in the market for them. And we have instruments that if they move 150, that's not a big day for them. So instruments that move more than others, of course, should be treated differently, because in these cases you can see that such instruments shows many times that the price is penetrating a support with 10, 15, 20 pips and then it comes back. But you do not see that with instruments that are calm and don't move much. The penetration could be 5 instead of 20. So here is your first factor. If I'm trading something that moves a lot like crazy, then I should place it a bit further. If I'm trading, for example, the Euro Swiss, a very boring pair, or the Kiwi, which has a limited daily range, I can place the stop 10 pips below the support, but I cannot do that when trading the pound yen at all. Of course, 10 pips is nothing when it comes to that pair. So maybe I'll place it at 30 pips below the support. This is the first point that you should consider. The second point is pip value, and the third point is the percentage of capital at risk, and they are related. They are closely related. When the pip value is higher, for example, the euro pound has a higher pip value than the euro dollar, and the euro dollar has a higher pip value than the Canadian dollar. So if I place a stop of 50 pips at the euro pound, my loss, in case the stop is hit, my loss will be different from a 50 pip stop on the euro dollar and also from a 50 pip stop on the Canadian dollar. So I always should look at this. How much capital am I risking? And you should always try to keep this number limited.